Hello, everyone, and welcome to the Quarterly Context webinar for the fourth quarter of 2019 for the clients of the advisory group. I'm Greg Patterson, the CEO of the advisory group, and these quarterly webinars are designed to provide high-level perspective regarding economy, markets, investor behavior patterns, and other information to help both our personal wealth and institutional clients stay informed and better achieve their goals with more confidence and peace of mind. We try to keep these meetings to about 20 minutes, and we'll circulate a video link afterwards should you like to view some part of it again or pass it on to someone you think it might be helpful to. And if you have any questions, please submit them to the question box, and we'll try to either answer them as we go along or at the end. In some cases, we'll answer them at the end if we know we'll be addressing them during the presentation. So let's get started. As a reminder, it's always important to focus on what's most critical, and that's oftentimes the intersection of things that matter and things that you can control. Of course, it doesn't make a lot of sense to spend time on things that don't matter or to worry too much about the things that you cannot control. So always the best place to start. If any of factors have changed for you or your plans or goals, of course, contact your advisor here at the advisory group, and we will always do our best to help. As a quick snapshot of what markets did recently, the fourth quarter was another very strong quarter with equity markets generally in the 8 to 12% range. Emerging markets being particularly strong, almost 12% for the quarter. Real estate a little bit weaker than it has been, which isn't entirely surprising given how strong it has been for some time and what current cap rates are showing and so forth. The bond markets were quite a bit calmer than they were the prior quarter and last year, and you can see these one-year numbers for returns are through the roof relative to most past years and relative to the expectations. And really important to remember that these year numbers include a very strong first quarter, which is really a rebound quarter after a very tough fourth quarter. So keep that in mind. Data here below in terms of what the best and worst quarters were for these asset classes to give you a sense and reminder over time what that can look like, the highs and lows. It's very important to remember that equity markets don't only go up despite what it seems to feel like in the last number of years. And people have forgotten that some of the years in the last 10 years were not all positive. But again, important to remember that it can and will go both ways over time. You've probably read or heard the news, so won't go into too much depth here, but some of the elements that have moved markets and some of the bumps and a little bit of the volatility along the way related to Fed rates in terms of cuts, tariff talk and potential deals, improvements regarding tariffs, potentially Brexit seeming to take some more formal and final shape, but still a lot of questions out there on those and other topics. This is the time of year after year end we like to pull out the periodic table and show you an updated version. Don't worry about not being able to read all the small print here. The message, of course, is that returns are variable and unpredictable. This chart shows year by year over the last 20 years what the best performing asset class was at the top, the worst at the bottom. And what you can see is that year by year, it's all over the place. And if you ever think you've identified a pattern, for example, real estate being at the top for several years in a row, then guess what? It tends to drop some at some period after that. So just a good reminder of the need and importance of diversification. A well-diversified portfolio will always contain the top performing asset classes and never hold too much of the weakest asset class. After the end of the year, we also like to take a look at the updated very long-term return patterns through this histogram. And this little mountain chart shows that this line down the left of middle, negative on the left, positive on the right, and each column represents a 10% return increment. And what you can see is that long-term history is significantly skewed towards positive returns, and the bulk of them happen most commonly in the 0 to 10% range, then the 10 to 20% range, and so forth. And what you can also see is that in the last 10 or 12 years, there have only been a couple of negative returns. One of them was the global financial crisis with the drop of 37%. But what's really amazing and has been very powerful for portfolios, but something that you don't want to take for granted because it's unlikely to persist at this level, is the high level of returns in the last decade. The very high level of returns, much higher than average, partly due to the very strong monetary policy stimulus, cheap money, low interest rates that have really fueled this market, amongst other factors, but that's one of the big ones. So 2019, up 32.4%, tied with the other top return for the last decade or so. And that puts those two returns in the top 20 returns or so in all of history, recorded market history. So that's an interesting time to lead into the information that usually comes out about this time of year regarding the projections for markets moving forward. So we take a look at the Callan data that we access, and these numbers represent the 10-year projections. So not on an annualized basis, the 10-year projections starting in 2020. And what it shows here is that we tend to look at the geometric return versus the mean or the arithmetic return, because the geometric return actually calculates in the impact of volatility. That's why those numbers are a little lower. So the geometric return is more like the actual return that people are expected to experience over time. So that's when you're looking at returns in one place or another and projections from other sources, make sure you know which you're looking at, because you may say that'll help you understand why there's oftentimes a difference. And what you should care most about is the return that you're likely to actually experience adjusted for volatility. So for the most part, stock asset class projections are roughly the same. In fact, essentially identical, as you can see in the difference column here. And fixed income, however, after last year's increase in projected return, followed by the Fed's somewhat surprising further easing of 3 rate cuts in 2019, what some are calling the Fed pivot, has led to a reduction, a pretty significant reduction in the projected returns of bonds over time, because the farther rates have gone down in terms of Fed cuts, the more they have to go back up to get to eventually to revert to the mean or towards some more normal level of rates. And that when bond rates go up, bond prices go down, and that can create some impact on bond returns. So that's the high level message there. Stocks the same, bond projections down. As a result of bond projections going down, that changes the nature of the capital structure a little bit and leads to a little bit higher standard deviation as well for stocks over this coming period. So to go a little deeper on that, try and whip through this, but there are a number of interesting notes in that context, given that this is such somewhat of an unusual capital markets projection year and shift. What the term that we're hearing a lot is the idea of a growth recession, where GDP and growth may not go negative, but maybe it will hover around the 1% level, or maybe even a little bit lower. It keeps moving, but at a slower rate. It's expected to be even slower outside the U.S., which also impacts returns and risk projections. One of the interesting drivers of some of these dampened economic cycles, some wonder why hasn't there been more volatility or more economic cyclical shifts. And some would say that the increased reliance and explosion of the service economy, particularly in the U.S. and developed countries, has smoothed out some of those cycles, as well as innovations in inventory management and production. Another factor is the U.S. population growth is at the lowest level in decades. That has implications for who will be buying what and how much, which of course in this case would lead to lower profit expectations. And this idea of the growth recession concept may be what the yield curve had been predicting in recent quarters when it inverted, and we'll take a look at that again, an update on that chart in a moment. So this Fed pivot, as it's called, is a pretty important impact in terms of the capital market expectations, because bonds were really expected to go up, not down, in 2009 in terms of rates. And so what that means is, or what the expectations and some of the Fed survey of the participants in the Fed, it appears the consensus seems to be that there would be a 2% rise in rates over the next 5 years. And that may be gradual, or is expected to be gradual and not immediate, but that would have lead to some potentially negative bond returns at some point during that period. The Fed, however, has been pretty effective based on what we're seeing now in terms of that management of rates and so forth, and roughly leading to a seemingly stable economy at this stage, even if growth is expected to slow. One notable thing in terms of the U.S. versus other countries, the dependency on trade is dramatically lower in the U.S. relative to other countries. So China here shown at 40%. The reason that's in quotes is this is based on official Chinese reported numbers, which is expected to be considerably or potentially materially lower than the actual reality. UK at 61, Germany at 87%. And you may recall last quarter we showed a slide that showed the size of each U.S. state as it would rank on the global stage if they were each countries. And that gives you a sense of how these sub-economies help drive demand here locally in the U.S. Inflation is still a big question. Economists are really struggling to understand why there hasn't been more inflation, even expected in great part because the wage inflation hasn't really been as strong as it would normally be in a period of some persistent growth, even if lower growth. Maybe global competitiveness is a factor, so those are some of the questions out there. So overall, again, the bond projections down about 1%, stocks about the same, still around 7%. And I think the key message we would relay here is to be careful since that will lead to a slight lowering of the projected returns of an overall portfolio, to be careful about jacking up risk by increasing equity exposure too much to try and eke out more return, because that risk, there may be a surprise where that could come back to bite. An update of a chart we've shown before as well, given that we're talking about capital market expectations, to give some historical context. It used to be easier to get a 7.5% return. Now, remember that this is before inflation adjustments, and there was higher inflation in the past, so that's something to consider. But in 1989, the projections were for us to get a 7.5% return wouldn't require any stocks at all, because given where bond rates were at the time. In 2004, would require about half bonds, half stocks. And the projection now is that we require 100% stocks almost, with only 4% in bonds. So it's harder to get the same level of pre-inflation return, not quite as hard on an inflation-adjusted basis, but still there are definitely dampened return expectations for the foreseeable future, some period of time, given the global slowdown in growth and not having a clear path to what the next level of productivity boost will be. In the past, it might have been the Industrial Revolution or the personal computer or the smartphone. What's next that would help that? So that's a question to be determined. Some would say it's artificial intelligence, but still very early in that game. In terms of valuations, with the strong fourth quarter, you can see valuations have pushed up a little bit, relatively overvalued, not dramatically, but still overvalued relative to 25 years of history. Developed markets a little bit overvalued as well. Europe specifically right around the average, and emerging markets just a little bit under. Japan's a little bit of an anomaly here in terms of this chart, and I won't go into why at the moment. Happy to talk about that some other time. And then the yield curve, which has received a lot of focus in the last year, has actually normalized a little bit here. It appears that this quote-unquote growth recession concept, and it appears that some of the risks aren't really playing out, but it may be that what the yield curve, by going negative or inverted rather, was predicting was a cool down, a slowdown, and that's not inconsistent with the growth recession idea. Maybe it just won't go negative, but hard to say. Typically, the impact of after the yield curve, it usually takes on average 20 months to find out. So the bond market is, by having a more normalized yield curve, is suggesting, well, maybe a full recession won't happen, or maybe it'll be a mild one. TBD. On similar themes in terms of where we are in the cycle, we've been showing different charts in the last number of quarters about this. Currently, economists would say that we are somewhere in the late stages of the economic cycle, a sort of slowing down of the expansion. And in terms of behavioral finance, how you can influence, going back to the idea of what you can control and what matters, in the context of having the longest bull market ever, having a decade of easy money policy in terms of rates and QE and other kinds of stimulation, some investors are becoming a little bit complacent, forgetting that risk can happen. And given that valuations there are questions about that as well. The key thing is to have a plan and have one you can stick with, whether you're a personal wealth client or an institutional client. Have an approach that makes sense. Don't go off the reservation in terms of risk. Try to focus on what's needed to accomplish your goals, and be aware of how the brain works. The more people feel comfortable and feel like there's a sort of myopic bias around what risk is, recency bias, people tend to think, well, there's not that much risk, so I shouldn't be too concerned. But just because risk has been relatively low doesn't mean it won't happen. So try not to allow yourselves to get caught up in that game, and just being aware of it can help. There's interesting, in terms of the personal wealth corner, interesting research that shows that the way people are living their lives is changing. More people are working later, and some of the research we might have talked about a year or two ago talked about a group maybe on average in the lower income, as it might pertain to the average 401k participant. But in terms of the average higher income or higher wealth person, people are working longer, not because they have to, but because they want to. It might be a reduced schedule, but doing something they enjoy more, But the more years of health, greater sense of community and accomplishment are some of the motivators for people for that. And this chart here shows the percentage of people who don't have limitations regarding the ability to work or do physical activities, and that number has grown over time. And as a sneak peek, this folds right into and supports some of the work we are doing with some clients, and we are writing a paper around it, that the idea of a midlife gap year. Some people are finding, well, hey, maybe I want to work longer. Maybe I would prefer to have for example, take a year off and plan and design their work and personal lives around that. So to have really two retirements, one in the middle and a longer one at the end. So you'll hear more about that in the future. Just wanted to give you a sneak peek on that. So this is where, this is the end of the first section. Of course, we won't be able to hear your feedback right at this moment, but we always want to hear if you feel well supported, how we can help you better. And of course, we always value when you are helping us meet others that are like you, that we're able to help as well. That's what we love to do. So this is the end of the first section. Now I'm going to jump into the second section, which is more of the detailed charts for those that are interested. I'll still try and go relatively quickly. And of course, follow up with any questions if you have them, please. So there's 4 bad bears charts. Chart shows that the current market in blue, after that cooling in the little while back, has had a pretty strong boost, in part because of the interest rates we talked about, and recently as well. This is even on an inflation-adjusted basis. This recovery has been the strongest relative to the other 3 worst markets. Volatility has been relatively low, given that it's been mostly market rise recently. But remember that these upper peaks of volatility can occur, so don't be surprised when that happens, and inevitably it will happen at some point. And that can be a compounding effect for a while when complacent investors regarding risk are reminded that there's risk, and then the behavioral finance kicks in for some, and there can be sell-offs purely based on emotion. So try to remember that that is not a game you want to play, that you are in it for the long run and the long term, and don't want to sell low and lock in those losses. You've got a long-term game, a long-term strategy. So a few elements here. I won't go into a lot of detail. We've covered some of these already. The only one I'll point out is a specific number, that this is now 129 months of bull market for the S&P, which is the longest ever, and a cumulative return of almost 500% since the bottom of the global financial crisis. So that's great. Let's celebrate that. Let's enjoy that and how that's happened as part of portfolios. But let's not expect that to be the norm, because it won't be. In terms of economic snapshot, GDP remains hovering around this low 2% level, but now, again, another record, 125 months as of a month or so ago, in terms of the longest expansion ever. So what's interesting is that this slower growth has led to fewer imbalances, which is why some are saying maybe there hasn't been as much volatility, and that could persist for some time. But the question is how long, and there could be, of course, hiccups along the way. We talked about the Fed rate cuts. Now the range is 1.5 to 1.75 as part of that, what they're calling the recalibration of policy, rather than being a more aggressive monetary policy approach. And for inflation, still hovering in that low level of 2.1 stubbornly, confounding many economists who would traditionally say that when there's been so much monetary policy stimulus, there has historically almost always been a significant inflation response over time. Unemployment, 3.5%, a 50-year low. That's 112 months of straight gains, also the longest ever. So a number of records being broken here. However, interesting to note that the birth rate cooling leads to long-term issues potentially in terms of employment sourcing and labor availability down the road. That's not really an issue quite at the moment. Wage growth ticked up slightly, still a bit weak, still below that longer term average of 4%. That could explain some of those inflation factors. Consumer confidence is up and is now about 15 points above the long-term average. That sometimes happens when people are a little overly confident about what's happening in markets in their own situation, and again have recency bias. So can be seen as a positive, can also be seen as sometimes as a predictor of a little bit of cooling, but TBD again. I won't go into too much in terms of housing. Oil cooled off a little bit. That's part of what, if you pull oil and food out of inflation, inflation has actually gone up a little bit more. This is the with food and energy. If you exclude food and energy, it's a little higher at 2.3%, still not through the roof or anywhere near that. I think maybe the most notable thing for a while, maybe a year or two ago, we, in terms of geopolitical wildcards, we added the U.S. as a question mark. And just this month, the Eurasia Group ranked the U.S. as the top geopolitical risk, given concerns about some things that are happening now and the implications and the perception around the world about how resilient will U.S. institutions really be. And elections are one of those questions also. So this is a new discussion, a new dynamic that may impact markets as well. In terms of the taking some of those economic metrics and taking a farther step back, you can see the patterns here for unemployment has kind of cooled pretty consistently. Maybe starting to hover a little bit around that rate. Wage growth had picked up a little bit, maybe hovering and flattening out a little bit. Inflation remains at that stubbornly low level. Consumer confidence had dipped and then picked back up to levels where it had been hovering for a little while, probably due to the strong market. And here you can see oil has been on a downward trend for a while, with a few ups and downs along the way. For consumer and corporate and national debt, the average consumer debt load is down. That is positive and suggests more resiliency for the consumer in difficult times and more confidence. Household net worth is up, so the combination of those two things helps explain consumer confidence as well. Non-financial corporate debt has really expanded. I've talked about this before. Numbers haven't changed dramatically, but just as a reminder, the corporate bonds here in gray, that's really been a big increase there. And with cheap money, some are concerned that some companies are overreaching. Even if the lower rates lead to lower debt servicing costs, the sheer volume of debt may pose a problem for some companies if the economy destabilizes a little bit. And then the federal debt is high right now at levels that we haven't seen since around 1950. Those types of levels are usually associated with major war efforts, and that's not the case currently. And even without just this trend of lower taxes and higher spending is projecting a considerable increase that would get us back to levels not seen until from the mid-40s. So that's a longer term concern we should all give a little thought to. In terms of the quality patterns of higher quality stocks versus lower quality stocks, higher quality has been hovering around the middle, had a reasonably strong 2019, but for the most part, looking back over the last 10 years or so, has been in the bottom half. That tends to happen when there's more speculative, strong stock markets. Higher quality, a little bit more conservative stocks tend to fall out of favor. We include quality as a layer within parts of the portfolio to help provide a little bit less downside, a little bit less volatility when markets get bumpy. So that's hopefully helpful to know. In terms of mutual fund cash flows over recent periods, the biggest flows have gone into bonds and stocks, which is interesting given that the stock market has been going up. So a little bit counterintuitive there relative to the typical pattern, but also interesting in particular, given that money market and cash accounts are paying almost zero. And as we talked about now, with bond risk expected to go up, people may be seeing, well, hey, the recent bond rates, you may recall last quarter was almost, the bond rates have been, bond returns rather, have been very high, in the 10+% range in some cases, which is unusual and maybe misleading investors into thinking that that's going to be a common thing in the future. Whereas, as we talked about a moment ago in the capital market expectations, bond projections are down, and those boosts from that bond prices from the rate cuts that have happened are unlikely to be part of the near or medium term future. So investors seem to be seeking high returns with low risk, and may just get a little bit of a reckoning there when reality rears its head as rates start to work their way back up over time. In terms of value, another deeper dive on valuations. We saw this chart here earlier. Here's the trend of what's valuations. You see how it's shaped over time. And then if we look at a 10-year price earnings chart, we can see more specifically that the most stretched valuation area is large cap growth. And that is where the biggest names, whether it's Google, Amazon, Netflix, and others that have strong earnings and no immediate necessarily concerns about or obvious reasons to doubt earnings in the short run, but could have a surprise hiccup for regulatory or any other reasons, or if the consumer pulls back suddenly. So just be aware not to get overly excited, and you have friends that are piling all of their money into large cap growth stocks. They probably have a lot to brag about right now, but they will probably be hiding with their tail between their legs at some point in the future, like people have done in the past. In terms of rules and regulations corner for the quarter, the personal wealth side, I'll refer here to the Secure Act in a moment. There may be some opportunities there for small business owners and others to take advantage of some of the updated, the new regs. We talked a little bit about this, but we kept this on here as a reminder that since that hasn't been concluded, that the Supreme Court's going to be evaluating whether or not the Consumer Protection and Financial Protection Bureau is constitutional, and that could, if unwound entirely, could further erode some of consumer protections and regulations that tend in the long run to increase volatility. A good example of that is the pre-global financial crisis financial deregulations that eventually led to be a big contributor to the global financial crisis. Our online WealthStep advice tool for 401k plans and kids and friends and family of our personal wealth clients is still making progress. We'll keep you updated on that. But just a quick peek at the Secure Act here. Won't go into all the details. You can read this or discuss it with your advisor. But one of the more material shifts and changes in terms of retirement plan regulations in quite a while, maybe 10 years or so, including some elements that are trying to respond to help the average person participate in plans that are part of the gig economy. Multiple employer plans are becoming a little bit easier to use, since some of the problematic elements of the regulations before that made that really complicated are being pulled out. And again, more to look at and think about there if you have questions. As a reminder, we have our blog post. You'll probably find a number of things that are interesting to read there if you haven't already. And if you have, we're getting a lot of good feedback about the content that we're writing here to benefit you, to give you things to think about, keep you informed, and so that you know what we're thinking about on your behalf. So take a peek there, and if you find something, share it with someone you know, that send them a link, and hopefully they'll benefit from it as well. So I want to thank you for your time. I appreciate your attendance today, and I will now pause to see what questions people might have.